Thank you everyone for joining us for this week's market update video. Joining me today we have FX and Nick. It's always exciting to talk about markets when markets are at all-time highs. It seems a little bit easier, right? Hopefully everybody's enjoying their summer. The portfolios seem to be enjoying the year so far. So hopefully everybody's in a good mood, feeling good about the summer. But there's always things to worry about, always things that we're keeping an eye on. FX, can you sort of give us an update over the last few weeks, what we've seen in the markets more broadly, and maybe get into some of the things that we're keeping an eye on?
Yeah, absolutely. I'll start first with kind of the positive and what we've been seeing up to this point, and then we could talk about some of the things we're keeping an eye on. So obviously, markets have been extremely resilient so far this year. We did have a bit of a pullback earlier where the S&P traded down to about 9%. But since that time, we've had a very, very significant rally. It's been driven primarily by technology stocks, and and that's been supported by some very, very strong corporate earnings. The expectations right now are somewhere in the neighborhood of 18% earnings growth for the S&P in 2026. That's a huge, huge number, especially knowing that we've just come off 3 previous years of very strong performance in the market. So those things are all positive, and markets, seem to be kind of shrugging off what's happening with the geopolitical war with Iran and the fact that we're going to come to some resolution. I think that's the assumption. But it is still a little worrisome when we've got oil prices at levels that aren't far from $100 a barrel. We're depleting reserves much more quickly because we don't have free flow going through the strait. So I think everyone, as Jeremiah said, is probably pretty happy with what they've seen in their portfolio so far, especially if they have a bias towards growth and technology. So what is there to worry about, right? This morning we had our investment committee meeting, and some of the things that we're kicking around that maybe give us a little bit of pause to say, hey, let's make sure we don't get overextended. One is the fact, if you look at fund flows, all the money continues to flow into technology as a sector. If we look at fund flows, it is just incredible the number of dollars that are going into that sector. And to some extent, rightfully so. We also have, we saw a spike in interest rates a week or two, maybe 2 weeks ago, got to about close to 4.7% on the 10-year Treasury. And fortunately, we've moderated off of that. But that was another kind of indicator to say, hey, if these interest rates continue to climb, that could also, cause markets to take a pause or even pull back. Nick, I don't know if you have any thoughts. I know you were part of these conversations too. Anything you want to add?
Yeah, I agree with everything you've mentioned, of course. I just want to kind of reiterate in good times like this, it's very easy to maybe grow complacent. And obviously that's not what we're looking to do. We're monitoring multiple areas, and I think really important to keep diversification in mind. And that's something that we're looking at in terms of just how much exposure do we have to concentrated areas. When something like tech really runs up, there was a point where tech was 40% of the S&P 500. We're approaching that again, and that gives our team ammunition, if you will, to start to say, hey, do we need to be making some slight tweaks to sort of take these wins? I also think about it from clients that are allocating new dollars or allocating into their retirement plans, whether it be work plans, IRAs, other things. Staying diversified is important in good and bad times. And the flows that we're looking at would indicate that people are sort of chasing, if you will, really good tech returns. And again, rightfully earned so far, but just keep in mind that expectations are really high. If you look at the rest of the S&P, it's done pretty well in the neighborhood 7-8%, depending on what sector you're looking at. But it's not had the tremendous run-up that we've seen in tech, which to my eyes would say, hey, there's actually room for them to grow because earnings have remained really good in most of the other sectors as well.
Yeah, if you look at the valuation metrics, sector by sector, to your point, Nick. Technology with the flows and the returns that they've seen over the last 2 months, even though they've had really good earnings, that multiple's got a little bit more stretched past its historical averages relative to the other sectors. So diversifying across sectors, I think, is important, and across geographies. Right, we've been a little overweight to the S&P 500. That's been a reasonable allocation for us for the year. Been overweight to small and mid caps. That has been a really strong allocation for us. We've had that one for a little bit. The original thesis on SMID caps is that a rate cutting cycle would benefit them. We've seen a really good earnings cycle benefit them. At this point, FX mentioned inflation concerns. An aggressive rate cutting cycle isn't necessarily on the horizon. So I think that's a place where in the small and mid cap space, you look at your allocation, and if you're overweight there, like we are in our models, I think that's a place where we're looking to take that win at this point and diversify back. Curious your guys' thoughts. There isn't anything that's a screaming buy to me. Valuations are all kind of across the board high relative to historical averages. The broad market is at a high. I think this gets us back to, at the moment, be diversified. And we talked about this earlier in the year, be diversified. And then when the opportunity presents itself, reposition the portfolio. Right now, it sounds like it's get back to diversified and then wait for the next opportunity. Any additional thoughts on that?
I guess I'll just add, I know we talked about this too this morning in our committee meeting, but I also think we do have a number of clients who every year and now have to take required minimum distributions. And I think at the current levels of the market, this is not a bad time to maybe go ahead and get those done, because we're going to have to do it before the end of the year anyway. And I just think, we're at record highs in the market. It's not unlikely that we see some sort of kind of mid-year slowdown. It's hard for me to imagine the consumer's been, continue to spend throughout. But I think we're getting to a point where it's going to become more difficult for the consumer to keep supporting the economy here at, some of the current rates that we're seeing in terms of buying food, filling their cars up, traveling. I think we could see some slowdown.
The one thing, just point of clarity, I don't think we're suggesting getting defensive or moving from equities to fixed income. It's just making sure that your equity allocation is appropriately diversified at this point in the portfolio. Sometimes it's easy when the markets are at highs. It's hard to think about them getting higher, but I'll argue that earnings expectations are still really strong. The valuations aren't at all-time highs, so there's still room for the equity markets to move higher here through the rest of the year.
Yeah, agreed.
I want to touch a little bit on IPOs. I'm not going to talk specific IPOs. There's a number of IPOs that are in the headlines, some coming a little bit sooner than others. Just around the mechanics, a little bit of an IPO. And as always, after these videos, feel free to call us with questions. We're happy to continue these discussions. What you'll see in the headlines is company's going to IPO. Oftentimes a lot of excitement around the IPO, the timing of that. There are instances where our IPO shares at an IPO price are offered to retail clients. They often don't make it to retail clients because they're often allocated to institutions, right? So custodians like Schwab, Fidelity don't often even get allocations. And the rare instances, some IPOs, if they're large enough, will allocate shares to those institutions. In the event that you qualify for those shares and submit interest for those shares may be allocated to you. It's based on an algorithm, basically, and a function. It's not an allocation to the team, and then the team is allocating. So by the time you get down to all of the different iterations of the potential allocations and the relatively low probabilities, it tends to be a relatively very low probability that a retail investor is getting IPOs at an IPO price. So then often what we'll see is clients interested in an IPO, we're looking to purchase the shares on the first day that they open. So I want to just walk through the mechanics of that a little bit. There will be an IPO price posted that day. That position likely will not trade at the open during the day because there's tickets coming in. Market makers are looking at interest and trying to figure out what the right price is for that to actually open to start trading at. And it may not start trading until the afternoon of that day. And you don't know what price is going to be executed. That price could be twice the IPO price. It could be half the IPO price. So it's very challenging to know what price you're going to get. And we would just be cautious on making those purchases. These are highly speculative investments over a longer period, perhaps not, but in that first trading window, they can be very difficult to sort of gauge where the price is going and what a quote reasonable price is on those days. So again, happy to continue having conversations with folks as you're interested. Please give us a call. Happy to talk more. Guys, any additional comments on IPOs? That was sort of the quick and dirty. I could go on for probably another 20 minutes, but
No, I think you said it best. It's very difficult to get access to those shares. Certainly, if someone's interested, we can express interest to Schwab, the custodian, but I think you have to have a reasonable expectation that it's very, very difficult to gain access and to get a meaningful allocation.
yeah. Great summary, FX. I should have just said that. Well, again, thank you for taking the time to watch our video and join us. As always, call us, email us with questions. A quick reminder, there will be information in the email with this video, but we are hosting a happy hour down in Avalon this summer on July 24th. So please let us know if you'd be interested in attending. We'd be happy to have you there. Thank you again.